One of the best ways to be great is to study those who are already great. One of the goals I have for this channel is to strive for greatness in investing every day. I want this to be a community of investors that want to be the best investors that we can be. But we need to measure ourselves against those that already achieve that level of greatness every year. Consistently beat the market, consistently stick to their investment plans, and consistently study the best businesses in the entire world. That set of people are the super investors. And today we are looking at what they bought and sold in Q1 of 2024. Welcome to The Quality Investor. It's always fascinating to see what these investing giants are buying and selling. They are the best in the world at this game, and I believe that we can learn a lot from them. What they do is instructive for a few reasons. First, it provides a template for what a good business is. By finding patterns in their holdings, we can create a picture of what a good business looks like. Secondly, it provides insight into where the trends are going. What industries are they buying or selling? Are there moves a hedge against the economy one way or another? And third, it can provide validation. Sometimes we make buys that the market is pretty sour on, and if we see the greats buying the same things, it can reinforce our decision. Believe me, I bought stocks that promptly fell 20% in the weeks after I bought them, and it can really test your resolve. It's good to see others that have a proven track record that have the same conviction as you do. Before going forward, please remember to like this video and subscribe to the channel so you can stay on top of all the quality businesses in the market. So, what investors are we looking at today? I want to review Chuck Akre of Akre Capital Management, Chris Hohn of TCI Fund Management, Bill Ackman of Pershing Square Capital Management, and finally, my personal favorite, Terry Smith of Fundsmith. This video is actually part one of sorts. I'm going to go over some other investors later in this week. It's also important to use their activity as instruction rather than copying what they do. We don't know when they bought or sold these stocks, and they may have access to certain deals that retail investors will never be able to access. But you know what's notably missing from the super investor activity? GameStop. I mean, really? GameStop is pure gambling. But also, NVIDIA. In fact, most of the activity around NVIDIA has been selling in the last couple quarters, suggesting that these investors are taking profit. Don't get me wrong though, I believe NVIDIA is a world-class business. I even use an NVIDIA GPU on my rig. But one thing that I can't do is predict with any level of certainty where the AI market will be in 1, 3, or 5 years from now. I just don't understand the AI market yet. It's just too young. And on the other hand, Costco and Visa are very simple to understand. They have such simple, predictable business models. So without further ado, let's start with Chuck Akre. I chose these investors because they have very similar investing philosophies to what I have. Chuck Akre, for example, likes to buy companies with wide economic moats and long runways of growth. He also likes to have a super concentrated portfolio. As you can see, MasterCard is 18% of his portfolio, Moody's is at 14%, so he doesn't hold that many stocks. That's something I'm trying to go for my own portfolio, really getting to a very concentrated set of stocks I believe will be very big winners over the long term. He also holds some businesses that I like as well. For example, I own Visa and American Tower Corp. And overall, he has a lot of businesses I would really like to buy. MasterCard, Moody's, Danaher's on my watch list. But right now, I don't think these companies are selling at a fair price for what I would like to buy into. But that said, you can see he's sold a lot of his positions recently in his portfolio. Now, I wouldn't trust this reported price column too much. American Tower Corp, for example, he started buying that back in 2009 when it was like still in the 40s, $50 a share. So while he reduced his position in American Tower by 9% in this quarter, I'm sure he sold at a very nice gain. But we can see what he did in Q1 of 2024. He added 2 new positions, Uber Technologies and CCC Intelligent Solutions. But other than that, it looks like he was taking a lot of profit. And on top of that, it looks like he's selling out of Dollar Tree completely, as well as Brookfield Asset Management. I can't speak a lot about Brookfield Asset Management, but I do know that Dollar Tree has been having a lot of struggles in the discount market. Along with Dollar General, both of those stores have not been doing well this year. And in retail in general, there's been elevated levels of theft, suggesting that he may want to get out of that margin squeezing business. But most of his other sales appear to be profit taking. Maybe he's accumulating capital because he sees other things that he'd like to buy. Next, we're looking at Chris Hohn of TCI Fund Management. He certainly has a very concentrated portfolio, only holding 10 stocks. His largest holding is GE which has been quite the winner for him. He started buying GE back in Q2 of 2023, and since June 30th, the end of that quarter, GE has returned an astonishing 90%. So he certainly saw something in GE that many other people did not see. And you can tell he's had incredible performance over the last 10 years. 21% 1 year, 16.2% on a 3-year basis, 100% on a 5-year performance, and 203.6% on a 10-year basis. He also holds some stocks that I would love to own as well. I already mentioned Moody's, but he also has SPGI, S&P Global. He also slightly trimmed his positions in the railroads. Railroads, of course, are very wide moat businesses because of how the government regulates them. Essentially, each railroad has its own section of the country it can operate in, and it effectively holds a monopoly over that area of the country. His big buys in this quarter, of course, GE had a little bit to it, but also Google. And I did a video on Google the other day after their amazing quarter, so I'm glad to see that he and I are on the same wavelength there. He also sold 100% of his stake in Ferguson, which is in the industrial space, and he sold quite a bit of his stake in Thermo Fisher Scientific. He reduced that position by 52%, possibly to fund the buys of GE and Google. But overall, it seems like he's just taking profits on most of his other sells. Next, we're taking a look at Bill Ackman of Pershing Square Capital Management. Again, a very concentrated portfolio of only 7 stocks. And it's also very heavy in the services industry. We have hotels, we have restaurants. Howard Hughes develops real estate. He didn't have a lot of activity in the quarter. However, he did sell about 10% of his holdings in Chipotle and all of his holdings in Lowe's. The Lowe's sell-off caught my attention particularly because I actually have a pretty good stake in Lowe's. It's done well for me. I have about a 13% return since I bought it. His initial buys in Lowe's were all when it was under $100 in a share price, so it's done pretty well for him as a holding. Ackman cited as a reason for selling his stock, he says, Lowe's was a highly successful investment for Pershing Square, adding that his decision to exit after a holding period of nearly 6 years was to free up capital for new investments and in light of uncertain near-term earnings trajectory. So obviously he wanted some capital to fund some future purchases in later quarters. I'm going to be interested to see what those are. However, Lowe's has slowed down their earnings a little bit in the last few quarters. My main thesis for Lowe's was the fact they're in a duopoly with Home Depot and they effectively dominate the home improvement space. But that said, like we said, we don't want to copy what these investors are doing, and I certainly have no plans to sell my Lowe's stake anytime soon. In fact, he has lagged the market a little bit over the last 10 years. For reference, the S&P has returned about 181% over the last 10 years. And he's a little bit behind on the 1, 3, and 5-year performance as well. And finally, we come to my favorite investor, Terry Smith of Fundsmith. I really like his portfolio, probably because it has a lot of holdings that I have as well, and a lot of my core investment philosophies come from Terry Smith. Like my portfolio, Microsoft is his biggest holding, and he was very active in this quarter, reducing positions in nearly every stock in his portfolio. So let's start with what he got rid of first. He got rid of Johnson & Johnson and IPG Photonics. I'm not too familiar with IPG Photonics, but I certainly don't blame him for getting rid of Johnson & Johnson. It seems to be a very stagnant business, a slow grower, if you will. And one of Terry Smith's core tenets is in investments that have a very long growth trajectory. He rarely buys businesses just for their dividends. His other big reductions were in McCormick & Company and MSCI, which is obviously a business I'm very bullish on, Pepsi, and Qualys. And Qualys is actually a business I've been looking at quite in depth in the last few weeks, and it's something I might have a video for soon. However, most of these reductions strike me as taking profit or freeing up capital for other uses. You can see he's added quite a bit. We'll talk about these buys here in a second. But for MSCI, for example, he started buying that when it was under $200 a share. So large profits that he just took from MSCI. But we can see a few other stocks that he added here. A few of them that I own as well. So Texas Instruments was a big buy in this quarter, as well as Fortinet, which I did a video on recently. He also added Apple. And Terry Smith likes to buy businesses that are highly monopolistic. Zoetis, for example, is one of the very few pharmaceuticals that makes drugs specifically for pets. MasterCard is in a duopoly with Visa. But I was definitely interested in his Texas Instruments buy. I started buying Texas Instruments when it was sort of on its downswing last summer. And a lot of people were very skittish around their ability to actually fund their dividend. They were making very large capital investments, and it was really eating into their free cash flow. And a lot of people were worried that they'd have to take on a lot of debt to fund their dividend. I did a video on that actually explaining why I don't think they need to. And while it did bounce around for a while there, in the last month or so, the stock has been on a tear up nearly 18%. So I'm very optimistic about Texas Instruments' future due to the large capital investments they're making. They're really setting themselves up in the semiconductor world to continue to be the leader in the analog space. But it was nice and refreshing to see Terry Smith have that same mindset. The Fundsmith portfolio itself has had a very nice 10-year performance at 200%, which is above the 181% or so of the S&P 500, but is trailing the S&P and the 1, 3, and 5 years. But I think given the concentration of his portfolio and the high growth companies that he does have in there, he's very well set up to continue strong performance against the S&P 500. So that is my part 1 of what the super investors are buying. And like I said, later this week, I will have a part 2 talking about some other ones. You'll have to tune in then to see who they are. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.